Ever wondered why the housing market that seemed invincible suddenly crashed in 2024? The dynamics of the housing market are complex, yet crucial to comprehend. When it crashes, the repercussions ripple globally. The crash of 2024 wasn't just significant, it reshaped economies. To understand this, we need to go back to the events leading up to the crash. As we look back, the warning signs were all there. It began subtly, almost imperceptibly. The housing market was flourishing, prices were soaring, and it seemed like the sky was the limit. It was a time when interest rates were at historic lows, a tempting proposition for investors worldwide. The allure of quick, easy profits led to a frenzy of speculative investing. It was as if a gold rush had taken hold and everyone wanted a piece of the pie. The low interest rates were like fuel to the fire. Investors borrowed heavily, using the low-cost funds to buy properties. The logic was simple: borrow at low rates, invest in real estate, sell when prices rise, and pocket the difference. It was a seemingly foolproof strategy, and for a while it worked. But in the background, the market was slowly becoming inflated. House prices were rising, not because of an increase in demand or a shortage of supply, but because of the speculative investing. The market was caught in a positive feedback loop. Rising prices encouraged more speculation, which further inflated the prices. It was as if we were all on a roller coaster, climbing higher and higher, bracing ourselves for the inevitable drop. Warnings from economists and market analysts were largely ignored. The promise of quick profits blinded many to the risks. There was talk of a housing bubble, but most brushed it off. This time it's different, they said. The market will keep rising. But, as we've learned time and again, when something seems too good to be true, it usually is. The bubble grew larger and larger, fueled by speculation and easy credit. But like all bubbles, it was fragile. It couldn't keep inflating forever. There had to be a limit, and when that limit was reached, the bubble didn't deflate slowly. No, it burst. And then the bubble burst. In 2024, the seemingly robust housing market came crashing down. A wave of disbelief swept across investors and homeowners alike as the once thriving market began to crumble. This wasn't just a minor speed bump. This was a free fall that sent shockwaves through the global economy. The signs were there, but very few saw them. The housing market was bubbling over, inflated by years of aggressive investing and speculation. It was a house of cards that needed just a gust of wind to bring it down, and that gust came in the form of investors pulling out, wary of the signs they were starting to see. As the first domino fell, the rest followed in rapid succession. Prices plummeted, leaving homeowners underwater and investors scrambling to cut their losses. The market was in free fall, and there seemed to be no bottom in sight. In the midst of this chaos, Airbnb and other real estate platforms found themselves in a precarious position. These platforms, which had thrived during the boom years, were now caught in the eye of the storm. They had become a significant part of the housing market, and as the market went, so did they. The crash was more than just a financial disaster. It was a social and economic catastrophe that affected millions of people around the world. Homeowners saw their life savings wiped out, investors saw their portfolios shrink overnight, and countless others found themselves caught in the crossfire. But it wasn't all doom and gloom. Amidst the rubble, there were signs of resilience. Homeowners banded together to weather the storm, and some investors saw the crash as an opportunity to buy low and hold for the long term. The crash was devastating, but it was also a wake-up call. It served as a stark reminder of the risks inherent in the housing market and the importance of responsible investing and home ownership. It was a lesson learned the hard way, but a lesson nonetheless. The aftermath of the crash was felt far and wide. The ripples of the Airbnb 2024 housing market crash were not confined to the real estate sector alone. They permeated through the entire economy, leaving no stone unturned. Homeowners, once buoyed by the promise of a profitable short-term rental market, found themselves in a precarious situation. The dream of financial freedom had turned into a nightmare, with many left grappling with underwater mortgages and a market saturated with unsold properties. Investors, too, found themselves in the eye of the storm. Those who had heavily invested in the short-term rental market, banking on the seemingly unstoppable growth of platforms like Airbnb, were left with a bitter taste of reality. The plummeting property values meant that their investments were now worth a fraction of what they had initially put in. Yet amidst the turmoil, there was a glimmer of hope. The crash triggered a wave of regulatory changes aimed at stabilizing the market and preventing such a catastrophe from happening again. Governments and regulatory bodies worldwide took a hard look at their policies, tweaking them to strike a balance between promoting growth and ensuring market stability. In the United States, for example, stricter lending practices were enforced and new legislation was introduced to regulate short-term rentals. These changes were met with mixed reactions. While some saw it as a necessary step to protect the economy, others viewed it as an impediment to the free market. The global economy, too, felt the impact of the crash. Economists noted a slowdown in economic growth, with some even warning of a potential recession. However, these warnings were tempered with a sense of optimism, as the economic structures proved resilient, bouncing back from the initial shock. In the end, the 2024 housing market crash served as a stark reminder of the delicate balance that underpins our economic systems. It underscored the need for vigilance, for careful regulation, and for an understanding that markets, no matter how strong they may seem, are not immune to crashes. The 2024 housing market crash was a harsh lesson in economics and market dynamics. So what can we learn from the 2024 housing market crash? Well, we've journeyed through the prelude, the crash, and the aftermath, and it's clear that there are valuable lessons to be gleaned from this event. It's a stark reminder that the economy, while powerful and resilient, is also delicate and susceptible to fluctuations and disruptions. The first lesson is the importance of market regulation. The 2024 crash, like many before it, was a result of unchecked growth and speculative investing. Regulatory bodies have a vital role to play in maintaining stability and preventing such catastrophic events. It is crucial that they remain vigilant, proactive, and armed with effective tools to manage and mitigate potential risks. Our second takeaway is the significance of responsible investing. As we've seen, overinvestment in a single sector, in this case real estate, can lead to disastrous consequences. Diversifying investments is not just a strategy for individual investors, but a necessary approach for the health of the broader economy. It provides a buffer against market shocks and promotes a more stable economic environment. Finally, the crash underscored the value of economic diversity. An economy reliant on a single industry is like a one-legged stool. It's only a matter of time before it topples. A diverse economy with multiple strong sectors can better withstand shocks and recover more quickly when they do occur. But perhaps the most important lesson is one of resilience. The crash was a major blow, but it wasn't the end. Recovery and growth followed, as they always do. It's a testament to the inherent strength and adaptability of our economic systems. Ultimately, the 2024 housing market crash taught us that even the most robust markets can falter, but it's how we learn and adapt that truly counts. In conclusion, the 2024 housing market crash was a pivotal moment in real estate history. We've journeyed through its inception, the dramatic crash, the aftermath, and the valuable lessons learned. We've seen how the unexpected can swiftly turn the tide, how market indicators can serve as warning signs, and how resilience and adaptability are integral to navigating such events. Let's not forget the role of platforms like Airbnb in the housing market dynamics and the importance of regulatory measures. This event underscores the need for us all to stay informed and vigilant, to question the status quo and to always be prepared for change. It's essential to do your own research, to understand market trends and to make informed decisions. Remember, an informed investor is a successful investor. Until next time, stay savvy.